Have you ever thought about investing your money? Let's embark on a journey to understand the world of investment. Imagine having a magical seed. This seed, when planted and nurtured, has the potential to grow into a money tree. That's what investment is all about. It's about planting your money in fertile grounds and watching it grow over time. Investment is crucial because it allows your money to work for you, creating an additional source of income and helping you achieve your financial goals. But like any adventure, it comes with its fair share of risks and rewards. There are different types of investments, each with its own unique character. Some are like sunflowers, growing quickly under the right conditions. Others are more like oak trees, taking their time but offering a sturdy return. Remember, every investment comes with some level of risk. But don't worry, we'll explore how to navigate these risks in our upcoming scenes. Stay tuned. So, what are these different types of investments? Well, let's start with stocks. When you buy stocks, you're buying a piece of ownership in a company. It's like having a slice of the pie. If the company does well, the price of the stock goes up, and you make money. But if the company doesn't do so well, the stock price might go down. Next, we have bonds. Bonds are like IOUs. When you buy a bond, you're basically lending money to the issuer, which could be a government or a corporation. In return, they promise to pay you back with interest after a certain period. It's like lending money to a friend who promises to pay you back with a little extra for your trouble. Now let's talk about mutual funds. A mutual fund is a pool of money from multiple investors that's managed by a professional. The fund manager takes the pool of money and invests in a variety of stocks, bonds, or other assets. It's like going in on a group gift where everyone chips in, and a friend who's good at shopping picks out the present. Moving on to real estate. This is when you invest in physical property, like houses or commercial buildings. You can make money by renting out the property or selling it for a profit later on. It's like owning a lemonade stand and making money when people buy your lemonade, or selling the stand to someone else for more than you paid for it. Lastly, we have commodities. These are raw materials like gold, oil, or wheat. You make money if the price of the commodity goes up. It's like buying a bag of apples and selling them for more than you paid because apple prices have gone up. Now that we know the different types of investments, let's talk about the risks involved. Every investment type has its own unique set of risks. Isn't that fascinating? Let's look at some examples to shed light on this intriguing aspect of investing. Imagine investing in stocks. It's like being part owner of a company. Sounds cool, right? But here's the catch. If the company doesn't perform well, the value of your stocks might drop. That's called market risk. Now, what if you decide to invest in bonds, essentially lending money to a company or the government? You're promised regular interest payments and the return of your initial investment at a certain date. But what if the company goes bankrupt or the government defaults? That's credit risk, my friends. Then there's the real estate market. You might think, land always appreciates, right? Well, not always. The value of your property can decrease due to a variety of factors, like a downturn in the economy or a sudden increase in crime rate in the area. This is known as property risk. And let's not forget about commodities like gold or oil. Their prices can fluctuate wildly due to supply and demand, geopolitical issues, or even weather patterns. This is called commodity risk. You might also put your money into mutual funds, which are essentially a basket of various types of investments. But remember, these funds are managed by humans, and humans can make mistakes. This is known as management risk. Finally, there's foreign exchange risk. If you're investing outside your home country, changes in currency exchange rates can affect the value of your investment. Phew, that's quite a list, isn't it? But don't let it scare you. It's important to remember that with every risk, there's potential reward. The key is to understand these risks and make informed decisions. Risks are part and parcel of investments, but did you know you can manage them? Managing investment risks doesn't have to be scary. It's all about balance. Think of your investment portfolio as a balanced meal. You wouldn't want to eat only one type of food every day, right? It's not healthy, and it's also pretty boring. The same goes for your investments. This idea of spreading out your investments is called diversification, and it's a crucial part of managing investment risks. Let's break this down a bit. Imagine you've invested all your money in one company. If that company goes under, you lose everything. But what if you'd spread out your investments across 20 different companies instead? Even if one company fails, you've still got 19 others to fall back on. This is the essence of diversification. But diversification isn't just about spreading your investments across different companies. It's also about investing in different types of assets. You see, different assets react differently to market conditions. Stocks, for instance, might be doing well while real estate is on a downswing, and vice versa. For example, let's consider a diversified portfolio that includes stocks, bonds, and real estate. If the stock market takes a nosedive, the real estate and bonds in your portfolio might still be doing well, helping to offset the losses from the stocks. So, you see, diversification can help reduce the risk of losing all your money in one go. It's like having a safety net. If one part of your portfolio isn't doing well, others might be thriving, helping to balance things out. But remember, diversification isn't a magic bullet. It can't eliminate risks completely. Some risks, like market risks, affect all types of investments. But what it can do is help you manage these risks, making your investment journey less of a roller coaster ride and more of a steady climb. So, diversification is the key to managing investment risks. But how do you diversify your investments? Diversifying your investments is like creating a balanced diet for your money. Picture this. You wouldn't want to eat only one type of food all the time, right? Just as your body needs a variety of nutrients to stay healthy, your portfolio needs a mix of different investments to remain strong and resilient. So how do you diversify your investments? For starters, consider spreading your money across different asset classes. Just as a meal might include proteins, carbohydrates, and vegetables, your financial plate should include stocks, bonds, and perhaps a dash of real estate or commodities. Each of these asset classes behaves differently in varying economic climates, which can help cushion your portfolio from the ups and downs of the market. Secondly, diversify within each asset class. Think of this as adding different types of proteins, carbohydrates, and vegetables to your plate. For instance, within the stock category, you might choose to invest in technology companies, healthcare entities, manufacturing industries, and more. By doing so, you're not putting all your eggs in one sector's basket. Now let's talk about geographical diversification. Just like adding exotic foods to your diet can make it more interesting, investing in international markets can add another layer of diversification to your portfolio. There's a whole world of investment opportunities out there, and you might find that some foreign markets offer growth potential that your home market doesn't. But remember, diversification doesn't mean you should just randomly throw money at a bunch of different investments. It's about carefully selecting a mix of assets that align with your financial goals and risk tolerance. Keep in mind, diversification isn't a one-time task. It's an ongoing process. Over time, some investments will grow faster than others, which may throw your portfolio out of balance. That's why it's essential to review and adjust your investments periodically to make sure they still align with your goals. Remember, diversification is not about eliminating risk, but about creating a balance. Just like a balanced diet doesn't guarantee you'll never get sick, but it does make you healthier and more resilient. The same goes for a diversified investment portfolio. Investing your money can seem daunting, but it doesn't have to be. We've explored the many faces of investments, from stocks and bonds to real estate and mutual funds, each with its own set of rewards and risks. Remember, high returns often come with high risks. We delved into the world of investment risks, understanding that they're an inherent part of the investment journey. Market volatility, interest rate fluctuations, and potential losses are all part of the game. But fear not, for these risks can be managed. Managing investment risks comes down to diversification, the strategy of spreading your investments across different types. Like a well-balanced meal, a diversified portfolio can provide you with the right nutritional mix of safety, income, and growth. Invest wisely and remember, balance is the key to a healthy investment portfolio. Make informed decisions, manage your risks, and remember, diversification is your friend in the world of investing.